have a slide deck. Okay. I have a slide deck that I'm going to use, which I will make available to you guys, should you be interested in digging in further. And I also, of course, I'm on the directory for FDU faculty. So if anyone wants to reach out to me with any follow-up questions, please feel free to do so. So you have my email. I've been working as an adjunct at FDU for right around 8 years. And I've been teaching international accounting as well as what we used to call selected accounting topics. So I'm teaching that now, in fact, but it's now called advanced financial reporting topics. But I'll just tell you briefly my background. So I spent most of my adult life with one of the big four accounting firms, PwC. And I started off in audit. And so I was doing, I would call it like plain vanilla auditing, financial statement audits for companies in a variety of industries, some private, some public, kind of a diverse audit background. And then about 8 or 10 years into my career, I started to specialize in doing audit and related assurance work for public companies. And that's what I really enjoyed the most. And then I had an opportunity to continue to do that, but in an international setting. So I went overseas to Scandinavia, and I worked with non-US companies, helping them with accounting and financial reporting in connection with cross-border transactions. And so one of the things that I quickly realized was that their home country reporting practices were different, and it really kind of creeped into what I would call basically creeped into areas that were outside, what in the US we thought of as being traditional financial reporting. So for example, I worked a little bit in Norway and Sweden, and they had disclosures in their financial statements about diversity and the number of women in various positions at the company, the number of employees. And I said, hey, wait a minute, that kind of information is typically not in audited financial statements in the US. What's that all about? But, and then, then you look at the audit reporting that they were doing outside the US. And I was over there back at around the turn of right before year 2000. And so the audit reports, they would report on information much broader and much more comprehensive than what we in the US would report on. So they would report on management's discussion, they would report on this diversity information. And then finally, I encountered a number of companies that were doing corporate reporting on sustainability matters. So I started to deal with it back then, and the crescendo was kind of built. And so now what was taking place in Europe is, I think, taking place in the United States and also globally in terms of some type of worldwide convergence on a set of sustainability reporting standards. So that's what we're going to talk about today, and just a little bit of background. So I'm going to share my screen and bring up the slide deck. So bear with me just a second. Because you guys see my slide deck?
Yes.
Okay. So this is my briefing deck. Like I said, it's pretty long. I'll cover some topics more extensively than others. Try to stay attentive to what the clock says. So here's what I'm going to cover today. What is sustainability reporting? What's happening outside the US in terms of key developments on sustainability reporting? What are US companies doing now? What's on the horizon for US companies? What are the current third-party assurance practices with respect to this? What are the implications for an accounting student? And how can I learn more about this topic? So again, I'll share this deck with you guys so you can use it for your reference if you're interested in doing that. So a couple of polling questions. So you guys in Zoom, you have, I think, a raised hand function, right, in Zoom. So we'll go through this polling question. So polling question 1, I'd like to see what you guys have to say with respect to these questions. Which of the following best describes your experience with sustainability reporting? Have little or no experience with the topic? Anyone can raise their hand there? Okay. We've got a few hits. So, okay, next, I have read a few sustainability reports as an interested investor or a third-party stakeholder. Anyone in that category? No one's seen sustainability reports. Okay, I think someone has. I have prepared a sustainability report. Any chance anyone's done that? I've conducted a sustainability assurance engagement, or I consider myself a sustainability reporting expert. And there are credentials you can obtain in order to do that. Okay, so that gives me a sense of the background of the class. The next question is, which of the following describes your level of skepticism, or maybe to the contrary, conviction regarding the relevance of the sustainability reporting concepts in the US? The question, answer number one, I think it's of limited relevance to the capital markets. And I hope sustainability reporting does not become more widespread. Anyone in that category? I think your responses are confidential, so none of the other professors will see your response. Okay. Some form of mandatory reporting in the US seems inevitable, and I better get prepared. Anyone fall in that bucket? No? Okay. It seems like a European thing, and I hope we don't adopt it here. Anyone have that European bias? Okay, or anti-bias? It's an intriguing topic, and I think it's a real opportunity for independent accountants. Hopefully, after you listen today, will be more people voting for that one. And then finally, I think it's an important way for companies to report on their impact on people and planet. Okay, so we've got a few responses there. That will inform me in terms of how I go about going through this this deck. So let me just maneuver this around a little bit. Okay, so let me get into the to the questions that I laid out that I'm going to attempt to address. You know, number one, what is it? So it's a form of corporate reporting. And I'm talking about just corporate reporting, but in the context of corporate reporting, it's disclosing or reporting out on activities and on metrics that relate in some way to governance, the environment, and society. So that's, you know, really my definition, but that's basically uses most of the key concepts. Sustainability reporting, point two, it includes, you know, generally includes both qualitative and quantitative information. So it's going to have a lot of metrics regarding performance or, you know, data in certain areas, and in terms of environmental matters or societal matters, human rights matters, whatever the topics are. So it's going to have some metrics that are disclosed, and it's going to have qualitative information, typically related to things like the governance process and how these things are managed, and you know, the strategy setting. So there's an alphabet soup of terminology. So there's a alphabet soup in terms of the basic reference to sustainability reporting. So sometimes it's called ESG reporting, environmental, social, and governance are the key concepts there. So it's referred to as ESG reporting, corporate social sustainability reporting, sometimes CSR, impact reporting, you know, public citizen reports. So if you look at the websites of a reporter, and most US public companies do report some type of sustainability information, the way they refer to it, it is varied from time to time. So it's not like you're going to see an annual report on Form 10K or annual financial statements. The terminology they use is different. There's also in the world of sustainability a variety of frameworks or standards. So I'll just contrast this to GAAP or to financial reporting, where you have, you know, you have US GAAP, you do have GAAP for public entities, you have GAAP private company alternatives, but you have US GAAP, one framework, or you have IFRS. Well, in the sustainability area, you have a variety of frameworks and standards. So you've got, as you see in the parentheses, GRI, SASB, TCFD, and then a number of others. Another distinguishing characteristic, and these are all really distinguishing characteristics, is the notion of a wide variety of players in this space. And what I mean by that is, it's there's a term we use for financial reporting called the financial reporting supply chain, right? You've got preparers, auditors, audit committees. They're the parties in the supply chain for financial reporting. Well, a supply chain for sustainability reporting is arguably a little more complicated because there's a lot of data out there. There's data aggregators, data providers, research organizations, rating organizations that rate companies on their sustainability reporting, their climate change reporting, governance matters, and various discrete topics. So it's a very disparate and fragmented market. And a lot of these organizations, quite honestly, will inundate companies with questionnaires or requests for information about their activities in these different areas. So the supply chain is very different. So some other distinguishing or defining characteristics or things to share with you about the basics of sustainability reporting. Number one, most large public companies do some type of sustainability report. I think the numbers are north of 90%. There's a lot of research reports or studies that are out there, but most large public companies, and you pick your company if it's that you're familiar with, Chipotle, Foot Locker, Amazon, again, most large public companies, you can find a sustainability reporting, a report of some sort that they issue. Some just started doing it recently. Some have been doing it for 10 years, but it may not be integrated with their annual reporting. In the U.S., it's it's voluntary and very unregulated, and so the reporting companies do usually comes from something like stakeholder activism or stakeholder engagement. And so in the US, it's very different than it is in Europe. In Europe, it's increasingly regulated and mandated. So we'll talk about that in a minute. The communication channels are very disparate. Well, and what I mean by that is that the way companies report sometimes is integrated, sometimes it's not. Sometimes it's on the website as a standalone document. Sometimes it's just different layers of information you can pull out. So it's not like, again, you can go to a 10K and get it for every single company in the same format. And then finally, a key point is that the reporting and insurance practices are very disparate. It's not always audited. Oftentimes it's not audited. There's data out there as far as the prevalence of audits, but it's very spotty. It's not complete. So let me just back up and just share with you some definitions of sustainability. So when we're talking about this kind of reporting, the question is, what do we really mean? So there's a couple of definitions that you can look to. One of the commonly cited ones is this UN Commission on Environment and Development. And so they talk about this notion of development that meets the needs of the present without compromising the ability of the future. And then another good definition is what's in the UN sustainability or sustainable development goals. So this is a set of goals that essentially the world's countries have agreed to as part of this UN sustainability agenda. And they're actually also goals that many companies use to report on their progress. While it's focused on public sector and development, it's also used in the private sector. So it lays out, and you can find this on the internet, it lays out the types of goals that the world essentially has agreed to, and there's 17 global goals, and it covers everything from poverty, hunger, health, quality education, gender equality, to clean energy, inequalities, sustainable cities and communities, responsible consumption and production, climate action, life below water, and things of that sort. So that's a good lens to look at when you think about the scope of what's included in sustainability. So all these different standard setters that I mentioned, they tend to have their own framework or set of dimensions that they want you to report on. This is just a way of broadening that out and explaining, what some of the more common definitions of sustainability are. So let's talk about outside the US. I'm looking at the time is 4:49. So anyone has any questions, by the way, please jump in. I haven't seen any chats or any questions, but you have opportunities to do that if you want to. So outside the US, and I start with outside the US because it's much more advanced. And I think it's pretty commonly viewed as it being a much more certain territories outside the US are much more advanced in their reporting. So I'm going to focus a little bit on the EU. So in the EU, there's a non-financial reporting directive, and we'll talk about that. And that mandates certain reporting. They call it non-financial, but it's basically sustainability reporting. That's been out since 2000, or been in effect since 2018. So they've been doing this, for a while. Then there's a new proposal to expand that. That's the proposed EU Corporate Sustainability Reporting Directive. I'll talk about that. And then one of the big developments to highlight is this new International Sustainability Standards Board. So I'll talk about that. So this is all outside the US. So the first one was the EU Non-Financial Reporting Directive. So this directive, the way it works is the EU, through their commission and their governance process, will issue a directive, and then the member states have to put that into their local law. So, Sweden, Denmark, whatever, any member state has to put it into their local law, and then their companies that are subject to that and that market have to comply with it. So it was effective, as I mentioned, generally in 2018, and it mandated reporting by, as you see, large public interest entities. So that's generally public companies as well as banks and insurance companies in those states. So there were estimated to be about 11,000 companies that were subject to this reporting. So you can think of it as basically the public companies in the EU. So they allowed for different frameworks to be used, as you see in the last bullet. And we'll talk about a couple of those frameworks later. But the point is that there was not one framework they had to use. So what does this directive require? It required a description of the business model, and then information about these different dimensions that you see here. So environmental dimension, social and employee matters, respect for human rights, and anti-corruption and bribery matters. So these are things that needed to be included in the required non-financial reporting by these public companies in Europe. And they've been doing this, like I said, since 2018. So you'll see for each of these topics, I had to include information about their business model, the policies they pursued, the outcome of the policies, the risk, and the metrics. So again, for those dimensions that I just mentioned, these are the topics that they had to cover. So again, you can look at a public company in Europe and you'll find these disclosures. So a key thing to note is that their materiality is different from what you probably are familiar with as a result of your studies of accounting in FDU. So for this EU non-financial reporting directive, they had this concept of double materiality, which means that companies need to report not only sustainability information that is material to their financial statements, but sustainability information that is material to their impact on society. So that's what they call double materiality. And it includes what this inside out and outside in perspective. So that's the way that the EU's approached it. So that's a key point, because if you look at some of the other standard setting that we'll talk about, it's not the same. So I'm sorry, I'm back a couple of slides. So, and then the EU directive also specifies where the information should be reported and or when. So the where is is that they're allowed to either do it in a separate report or put it in the management report. And then if they happen to put it in a separate report, they have to make it available within 6 months. Well, think about it, that's not very aggressive. So one of the issues now, frankly, is timeliness of this information. And so that's one of the reasons, amongst others, that the EU is reconsidered this. And we'll get to that in a second. So the other thing I'll point out is the audit requirement. There is no prescribed audit requirement. There's a requirement for the auditor to note whether it's been provided, but there's no requirement to audit that information, although member states may decide that they want to require it to be audited. So there are some countries where this report that I'm talking about now is required to be audited. So just back up a little bit. We're talking about the EU non-financial reporting requirements. And so about 11 or 12,000 companies in the EU have already been reporting sustainability information since 2018 under these guidelines. But it's generally, for most member states, it's not audited. In many cases, it's actually issued 6 months after year end. And the bottom line is that in the EU, the regulators decided they weren't really happy with the quality of the information. So that's why they've revisited that. So they revisited it and they've come up with a proposal, which is pretty far reaching in terms of its implications. So this is the proposal I'm talking about now. It's called CSRD. And it's another proposed directive. So it's going to take a while to actually become law, but it's got a lot of momentum. As you see, it was proposed in April 2021, and it would amend that non-financial reporting directive. And so what it does is one of the big things that expands the scope. So rather than about 11,000, it expands it to about 50,000, and it goes to large private companies. And that's a big change because number one, it's 5 times the number. And then number two, there's probably going to be a lot of US entities that are subsidiaries of some parent company in the US. They have a EU domiciled subsidiary that's caught in this document. And the parent company will have to figure out how to deal with that as far as the reporting. Because again, they're private companies in the EU. They're a subsidiary of a US parent, but they have to do reporting on a standalone basis or perhaps on a consolidated basis to comply with this directive. So that's a big deal, just in terms of the gross number and then the implications to companies doing business in Europe. So it's getting a lot of attention. There's also a requirement to audit the information. So as you remember from the previous slide, there was no express audit requirement, but there is in this proposal. And then there are more detailed reporting requirements, and then a requirement for these companies to use these new mandated EU sustainability reporting standards. So they're developing their own standards. So remember in the non-financial reporting directive, they could use a variety of different standards, but now they're going to have to use these mandated EU sustainability reporting standards. And so they're developing those as we speak. So there's an organization over there that is developing a set of reporting standards that would be used once this thing becomes effective. And then the last requirement that's pretty important to note is this digital tagging. So the information is also going to have to be tagged similar to XBRL. So it's machine readable. So there's a lot in this. There's a lot to deal with. There are implications for US public companies. And then, oh, by the way, they also use the double materiality concept as well. So remember that double materiality was that inside out, outside in. So that's something that may be an eye catcher for a US company that may happen to use a more traditional view of materiality. So the last international standard international development I'll mention is this new standard setter called the International Sustainability Standards Board. And this is something that was just announced, I think last week actually. So the IFRS Foundation, as you may know, supervises this IASB, the standard setter for international financial reporting standards. Well, they decided to set up a new standard setter for international sustainability standards. So that's the ISSB. So the idea is that this board, it's a standard setting board, they'll develop a comprehensive set of standards is expected to be a baseline. So the baseline concept is that these are the base standards, and then individual territories can add to it. So it's kind of like a building block approach. You have a baseline of globally accepted standards or intended to be high quality, and make sure companies produce decision useful information about sustainability matters. And so they're going to follow a due process, and they have a governance structure and a due process for developing these standards. So for those of you who have studied the FASB, you know it's very similar to that. So there's a due process where they set the agenda, they publish drafts, they get comments on the drafts. They have working sessions where they get input and they make changes, and that's the whole, that's what was referred to as the due process. So the same thing is going to happen here with this new board. So it's big news. They're still in the process of filling the seats on the board. I think they probably have identified most of the candidates, if not the chairman and the vice chair. So it's a newly formed entity, and stay tuned. So they have issued, there was a working group that issued some prototype standards, and this so you can look at the prototype standards already, and you get an idea as to where they're heading. And they're starting with climate, and they've issued prototype standards for both general disclosures and also climate change matters. And they in the general disclosure document, you get an idea as to what their plan is for materiality. So the materiality concept is different from that double materiality that I was explaining to you. It's more I refer to it as a more traditional concept. So the concept of materiality for the ISSB is based on the impact on enterprise value and the needs of investors in terms of general purpose reporting. So the concept is sustainability is becoming part of general purpose reporting that's used by investors to assess enterprise value, to assess the timing and the certainty of cash flows on short, medium, and long term, and use that as a basis to make decisions about investing matters. So that's the approach of the ISSB. So remember that when I talk about materiality, remember the whole idea is to figure out what metrics, what ESG topics are material. So how do you do that? Well, you figure out for the ISSB, the idea is, well, materiality based on general purpose reporting and the use by investors of that general purpose reporting for making those decisions. Whereas in that EU directive, both the existing and the proposed directive, it's a different materiality concept. So that's why this building block approach is going to be so important to watch, because we got to figure out how these things fit together. So anyhow, other developments outside the US, there's a lot going on. And one of the big things I'll point out is that many territories and the regulators in these territories are now embracing what's called TCFD. So that's the Task Force on Climate-Related Financial Disclosures, and I'll talk about that in a few minutes. Okay, so that's a lot to digest, I know. So let me go to closer to home and talk about what happens here in the U.S. I'll take a cup of tea while I'm collecting my thoughts. You guys, anyone have any questions? No questions?
Excuse me, John, I have a quick question. The new board that's set up, is that also based in London?
Actually, I honestly don't know. I wouldn't be surprised,
Okay.
but I haven't looked at it. But I think it probably is. Is this Deidre, by the way?
This is Deirdre Collier. Yep.
Okay. Yeah, I'm not sure, honestly, to be honest. I don't think they really they had a technical working group. They probably work virtually, but they're probably, I suspect they might be based in London eventually. Okay. So it's a good question. There's so many groups out there. It's hard to keep track of where they're located. Okay, so what are U.S. companies doing now? So the point I was going to make is that, and I said this earlier, U.S. reporting is, at least at an entity-wide holistic level, is largely voluntary, and it's often in response to marketplace or investor expectations. So you've got activist investors, you've got institutional investors, or you have societal expectations. So that's kind of how the U.S. reporting is worked generally. And then I pointed out that there are some mandates for like regulated companies. So certainly a company that's emitting a lot of greenhouse gases or is in a regulated market probably has some discrete reporting obligations. And then listed companies and SEC registrants have some reporting, but it's not anywhere near to what's happening in the EU. So that's really kind of the intro to what's happening in the US. So just to give you some examples of these influences, what's influencing companies. So BlackRock, as an asset manager, like a lot of other asset managers, has expectations. So they publish these proxy voting guidelines. So they're managing assets on behalf of investors, and then they're voting on shareholder for the portfolio companies based on things that come up in the annual shareholder meeting. And so they've published these proxy voting guidelines every year, or periodically. I think it's more or less every year, indicating how they're going to approach corporate governance and reporting issues. So they're one example of an investor setting expectations as far as sustainability reporting. So they're kind of involved. The CEO is very interested in sustainability reporting. So what they've in their guidelines, they have some insightful comments. So and a lot of CEOs and CFOs of companies in the U.S. listen intently and read closely what they say, just like a lot of people read the Warren Buffett shareholder level pretty closely, maybe for different reasons. But this Larry Fink, his communications and then their guidelines are pretty indicative of where things are going, because they have such a big influence on the capital market. So a couple of the key points they say: number one, well-managed companies deal effectively with material ESG factors. Number two, disclosure is essential for investors to gauge what's happening regarding risk and opportunities. And then they've said that they think that the recommendations of this task force on climate-related financial disclosures and also the standards set forth by the sustainability accounting standards are an appropriate and complementary frameworks for companies to disclose. So they've more or less endorsed this TCFD, which is a framework for reporting climate-related financial matters. But they think it's a good framework to also use for other sustainability risks. And so they've essentially underscored that in their letter. And then what they've asked companies to do is to use that TCFD framework, which is, I'm going to refer to the deck later on where I explain the framework, but you can find the information on the web, and I've got a web link you can look to. So they basically encourage companies to use that framework for disclosed sustainability related risk. And they also encourage companies to publish reporting using the SASB. So that's the US based, San Francisco based Sustainability Accounting Standards Board. So that's one of the various standard setter that I mentioned. It's separate and apart from the international standard setter and some of the other standard setters we talked about. So that's one of the issues we have in sustainability reporting, is that there's all different parties and bodies and standard setters and framework developers, rating agencies. It's very confusing. So BlackRock is trying to add some clarity and saying, here's what we ask companies to do. So you'll see a lot of public companies have done exactly that in most recent years. So another example of investor expectations are shareholders. So they, as you know, oftentimes submit proposals for consideration at the annual meeting. And what happens oftentimes is these proposals are submitted, but eventually the company will negotiate with the shareholder that submits the proposal or the consortium of folks that submit the proposal and negotiate a settlement, so to speak. So they basically do what they're being asked to do. So sometimes asset management or individual activist investors. So here's just some examples. So these are kinds of the things that pressure essentially companies to do sustainability reporting. So that was Apple. McDonald's had a similar comment where the proposal was that the board of directors report to shareholders on how they're going to integrate ESG into compensation of their executive officers. So ESG metrics. So that actually comes from the New York State Comptroller. Charter Communications. So they're not probably a company you would think of as having a large carbon footprint, but the Illinois State Treasurer saw some issues, and they had a shareholder proposal for the company to issue an annual sustainability report that includes greenhouse gas emissions information, strategies, and metrics. So bottom line, what I'm trying to get at is, even though it's voluntary, largely voluntary in the US, investors, shareholders, activists, asset managers, et cetera, essentially the capital markets are pushing companies to provide sustainability reporting in some form. So they do have some mandatory requirements. You've got the new NASDAQ rules. So I don't know if you've seen those or not, but there's now some any company that's listed in the US on NASDAQ has to have 2 diverse directors or disclosures explaining why they may not have those 2 diverse directors. And then the SEC has some rules that are applicable to public companies. So public companies in the US, they're not necessarily providing full, and they're in their SEC filings, they're not filing typically full sustainability disclosures, but they're subject to some discrete disclosure requirements. So that's what I've summarized here on the slide, some of these discrete disclosure requirements. So there are disclosures related to climate change, cybersecurity issues, human capital management, and other topics that are sustainability topics that SEC registrants do have to report. But again, it's not a comprehensive sustainability report like you would see in the EU. So I just have a couple of slides that summarize some of those. Here's the climate change one. This is essentially highlighting the type of topics that a SEC registrant would have to disclose. Now, this would be embedded in their current filing. So would it be included in their description of the business, their management discussion and analysis, and some other parts of their annual report. So the SEC is pointing out, because of legislation or the consequences of regulation or business trends or the physical impact of climate change, you may have disclosure topics that you should put into your annual report or your MD&A, somewhere in your annual report, like your MD&A. So that's what they basically, this is something that came out in 2010. So they have some examples of disclosures they would expect companies to see. And they're really focusing on this right now because they're getting ready to issue their own rules that up the game, enhance, expand the requirements. But so they're looking at compliance with the 2010 guidance for SEC registrants currently. So I just have a couple of examples of disclosures, just so you can refer to them later. So Winnebago Industries, Vail Resorts, Phillips 66. I'm just going to highlight the one on Vail Resorts to just kind of illustrate how sustainability might impact operations. So they, as you may know, operate a bunch of ski resorts, right, in a public company. And they're explaining that disruptions in the water supply could impact our snowmaking capabilities. So this is the kind of disclosure a U.S. company would have. So it's not a comprehensive sustainability report, but it's an example of how sustainability topics are reflected in a 10K for a U.S. company. Phillips 66 obviously has a bigger carbon footprint and fossil fuel footprint specifically, and so they had some disclosures as well. There is another SEC disclosure requirement for human capital resources, which is brand new. So this was the first fiscal year that it was applicable. So you'll see that in SEC filings. Okay, so that's kind of the SEC world and NASDAQ. So I want to give you some highlights of some notable examples of emerging practice, right? So these are some interesting highlights. So maybe go down to the last bullet first. I probably should have put it at the last: standalone reporting. So it's most common for a U.S. company to do standalone reporting, meaning that they don't put it in their SEC filing, they produce a separate report. And that's their sustainability report. And then there is, of course, they have to address that climate change and cybersecurity and all those other SEC rules, but those are effectively reflected throughout the document, but there's no standalone report in the SEC filing. So it's a separate filing. But there are some exceptions to that. So the top two of the first exceptions I'll show you. So there's a company you may be familiar with if you like sneakers or fashion apparel called Allbirds. So Allbirds just did an IPO. They went effective on November 2nd. And they tout the fact that they're the first company to go public with a sustainability disclosure framework. So they're a public benefit corporation incorporated in Delaware, and they're a B corporation. And so contributing to society and addressing societal issues about environment, sustainability, and sourcing and stuff like that is part of their DNA and part of their corporate charter. But in their IPO document, and I've got a link there, you can look at it, they describe this framework, and they got third-party assurance on the framework for their reporting on sustainability. It's the first time that's happened that I'm aware of, and that's what they say in their own, and that's what it says in the press as well. Now, another good example is Etsy. Etsy Inc. In their annual report, they actually include sustainability reporting. So bottom line, is very rare for a public company to include sustainability reporting information, a sustainability report in their SEC filing. They might put it on an 8K, but it's not typically going to be in the 10K. Etsy's the only one I've seen. And then Allbirds is even a step further because they did this in their IPO document. But other than that, you typically see standalone reporting. So I just have an example here of Ford, so you can look at it. This is an excerpt from Ford's integrated report. It is actually integrated sustainability and financial report. So in their SEC file, in their 10K, they don't include this, but they do have this separate report, and then they explain how they've gone about. This is the table of contents, but they also explain how they developed the report using these different frameworks. So the key thing to look at on the far right, there's a long list of frameworks that they've used. So that's why this is such a complicated area, because you'll see they used GRI, they used TCFD, SASB, US Global Compact, and then the Sustainable Development Goals. So these are the things that they used to prepare the report. So if you were a cynic, you would say they're cherry picking, or they have a kind of a proprietary framework using the best of the best. So again, the key point is it's not like US GAAP. You've got one framework, one set of standards. Companies are picking their framework. They're picking the best of the best, or maybe a proprietary framework, or maybe they just use one framework. The practice is disparate, and once again, oftentimes is not audited. So what's on the horizon for US companies? So the SEC has been focusing on climate change disclosures. So they've been issuing a lot of comment letters to companies, asking questions about compliance with the existing. And then they have a rulemaking agenda. So in the rulemaking agenda, these are things that they're considering doing to impose new requirements on public companies. So they're expected to take up these issues and consider proposed rule amendments to expand the disclosure requirements. So they've identified on their website specifically what they're looking at: board diversity, climate change, risk and opportunities, expanding the human capital management disclosures, and then cybersecurity risks. So they're looking at expanding all this and monitoring very carefully what the regulators outside the US are doing, as well as the international standard setters, because at the end of the day, you know, we don't want to have US companies be disadvantaged. We also want to protect investors, and we want to do our part in terms of encouraging global consistency, and that decision useful information is available. And if you think about it, if a US public company doing business in Europe suddenly has to start reporting using the European framework, and they look at doing that, and then they're, in the meantime, they've got to deal with the SEC rules, well, maybe there's a conflict, or maybe there's a problem. So the SEC is looking at this very carefully, and you know, it's all about coordinating, contributing to the thought leadership, and coming up with a reasonable outcome. So I'm going to do a time check now, and then pause also and see if we have any questions. And I covered a lot of material. Keewan, what do you think? Should I speed tap dance to the rest of the slides and open it to questions? Well, let me do this. Let me just cover the third-party assurance slide and what's in it for you. That's what we'll do. So by third-party assurance, I'm referring to you know, audit, review, or whatever. So again, I've probably already made the point that most companies that are big public companies report in the US, and of course outside the US, but only a small amount provide any kind of audit report on that information. Now it's gone up. It might be like in some markets, maybe 50%, so maybe half of them. But it's not enough. Because if you think about the benefits of an audit, you know, people rely on it more, and the companies probably spend more time preparing it. You know, that's kind of cutting to the chase. The reality is a lot of non-conventional, there's engineering and consulting firms providing third-party assurance. So it's not always an independent accountant, you know, it's not an independent auditor. Oftentimes it's an engineering or consulting firm that does the work. There are standards that we have, AICPA and IAASB standards that are used. So if an independent accountant does the work, they follow those standards, but oftentimes it's a review, not an audit. And so that creates, you know, some issues. So the other thing to point out is that in the realm of third-party assurance, the subject matter that's subject to assurance is another issue, because oftentimes it's just discrete disclosure topics. It's not the whole thing. So it's like if you were producing annual financial statements and you only had your fixed asset footnote audited, right? So that's not an audit of your consolidated financial statement. So in this realm, the sustainability realm, sometimes there are entity-wide reports, third-party assurance, but often it's just on a specific dimension, specific section, or specific metric. And then in the greenhouse gas area, you know, there's some issues there, because when you get further down from scope 1 to scope 2, scope 3, it's further outside the reporting boundaries, and it's hard to audit. And if you think about it, the criteria used, which again, the analog is GAP, you know, that's varied too. So basically the bottom line is there's a lot of opportunity for us as auditors to be relevant in this space. So I just want to close off with this next couple of slides on what are the implications for accounting students. So I know I covered a lot of material, and again, you can go back to the deck or reach out to me individually if you'd like more information, but just to highlight some things that give you some ideas to the opportunities here. So certainly the size of the marketplace is significant as far as advisory services, ESG data and services. So there's a lot of firms that provide some type of data service, research service, consulting, advisory services in connection with getting companies ready to do sustainability reporting, or to expand it, or to incorporate it into the way they operate. So UBS Investment Bank, for example, had a report, and they said they think the total available market was 2.2 billion with an upside potential of 5 billion. The transition to ESG, by definition, if you think about it, we're talking about transitioning to carbon neutral, or transitioning an organization to accomplish certain things under other dimensions. Well, that's going to involve changes in job losses, job creation, new markets. So that basically the company that may hire you, or when you switch jobs down the road, you may be looking at their the climate footprint or their environmental practices as a basis to decide whether or not they're in a dying or growing industry, or they have some existential risk in terms of their operations. So by definition, there's going to be opportunities because of those changes. And then certainly corporate accounting, finance, and audit, there's a lot of opportunity there. I can tell you, if you look at if you talk to anyone from any of the accounting firms, are spending a lot of time in the space. You guys probably know that, right? And they're building up their competencies. They're, eventually going to be, they're training staff, they're training clients. There's, I know PwC is developing an ESG Academy. There's a lot of stuff going on in this space to educate people and get people up to speed. So I just wanted to make the point, at least my personal philosophy is that keeping current is a professional obligation. It's also a full-time job. And many people think that the ESG is the future of corporate reporting. We're making it more meaningful, we're expanding it, and there's a lot of information that needs to be incorporated into this type of reporting that's more forward-looking rather than historical. It involves things that maybe people don't have the same comfort dealing with. And the whole exercise is moving from investor relations to corporate accounting staff. So there's a lot for corporate accountants to learn and to be involved in and to be aware of. And again, at the end of the day, this stuff, ESG or sustainability topics, are essentially something that companies are going to need to build into the way they operate, the way they plan, the way they set strategy, and the way they make decisions as far as investments and policies and their strategies. So it's really an area where a lot of momentum is building. So finally, I've got a bunch of topics or content here that you can use to get more informed. So I've got in this deck, this is kind of the appendix, a bunch of information about frameworks and standards, and then some references to some useful websites. So here's the frameworks and standards section. And then I was just going to tell you that I would encourage you, if you're not already familiar with it, look first at TCFD. I say this because most of the regulators are saying climate first. The Biden administration came out with their climate finance action plan, and they talk about code red. We've got a code red related to climate change. So the standard setters and the SEC, they're starting with climate first, and they virtually all have said we like what TCFD has done, and we're going to try to embed the concepts of TCFD into what we're doing. So I would suggest familiarizing yourself with the TCFD recommendations in terms of what they suggest disclosing and how they look at it. So I've got a lot of stuff about that. And then the other thing I would encourage you to become familiar with, if you're not already, are the greenhouse gas protocol standards, because they're linked to TCFD and they're used by most companies for purposes of reporting their greenhouse gas emissions. So I've got information about that. And then finally, I've got these website links. So that's pretty much it. So Kiwan, you want to, can I kick it back to you and see if there's any questions, or what? We'll probably need to close down, I suppose.
Yeah, actually, I just want to make a comment too for all the students, especially for the seniors and the juniors who will be taking soon the strategic management class. In the strategic management class, we have a simulation called BOBUS and another simulation that we use. We basically do the ESG reporting in there. The more we put money into our social responsibility and like the greenhouse gas and all that, the more credit indication we get, and we have to basically, for us to pass the class or for us to win the competition of our company and be the best company in the industry, we have to pass the average of the industry for credit rating and other ratings for income, for revenue, and make sure that there's not much losses. And the more money you put into ESG, the more revenue you'll get over time. It's kind of like a long-term investment. So that's what I learned. And that's what, like, how disclosures, when you were presenting about disclosures, we kind of saw it from the reporting. When we needed to make decisions, we refer to it. If we need to put more money into our ESG during that competition or in that simulation. So for students, this deck will be helpful when you take that class. And I guess, I also learned a lot with, what's the future in accounting in terms of like ESG. Is there any other questions from the students? No, it is a lot, and it may be something new to you guys, but for me, it is not. I wrote a 20-page paper about sustainability development goals of the UN in Roxton. So if you go to Roxton, you gotta care for that.
Yeah.
Other than that, thank you so much, Professor.
Okay, you're welcome, and thank you, everyone. Nice to talk to you.
Thank you. Have a good one.
Thank you.
Okay, have a good night.
I, Quinn, where